Episode 4 of Sir Ulric hosts Money Matters. Some of you know I believe in the combination of Bitcoin and the internet will drive the education industry to become completely or near completely private or for profit. My guest gives tangibility to that prognosis. Why, you may ask? Well, James' breakdown of macroeconomic topics beat out anything I've learned in any of my master's business classes years back, and for a fraction of the cost. He delivers his thoughts clearly, but with an appropriate complexity, and makes you go back and reread or listen again if you are serious. And hey, that sounds like a great deal for any media platform algorithm. James, it's an honor to welcome you on the show. How are you, brother?
I'm good, Saren. Thank you for having me. It's awesome to be here.
Thank you, man. Hey, you know, I've seen you in person. I've seen you online, of course. And when you are on stage, you deliver some of the most complex topics that we have in society, and you capture them in a way that's like the common man can understand. And it's an honor to have you deliver those thoughts on my show. Sir Ulric hosts Money Matters. And for the people who are watching, make sure you subscribe to his newsletter, The Informationalist, which we will have in the show notes below when we publish this. So I want to get right into things. With you being on the show, I want to take that time to get some questions out that I have that I just don't get sometimes. So I have a few questions.
We're gonna talk about March Madness first, aren't we?
You want to talk about? Ask me. Okay, let's do that. So first things first. I hate the NCAA. I played Division I ball, and I just have an issue with college sports. I know you're a Yale man. You have this fervency for the old school. I went to Long Beach State, which doesn't have that drive as much. But go ahead, give me a question. I'll answer it.
Yeah, look, Yale made it. Yale made it to the NCAA, so
and that's why you're so happy. And so did Long Beach State, by the way.
But my daughter's over at UT, so that they definitely have a longer tail, you know. So I think if Yale gets to the next round, that would be tremendous.
Who are they playing?
I could see Texas winning a couple of games here. So we'll see. I don't know.
Who's Yale playing? Who's Texas playing?
Oh, I mean, I don't honestly. If I was paying that close of attention, it would probably be the wrong thing to be focused on.
That's right.
I know that coming out of the gates, Yale is playing Auburn, and so it's pretty high bar.
Okay, so from what I know, Auburn has beat some big team, some major teams. They're on the verge of being they're higher than a mid-major. I don't watch NCAA. I kind of sample it and kind of develop my analysis. I will say my final four would be UConn, Arizona, Creighton, and Marquette. Marquette and UConn are in the same conference, and I expect UConn to beat Creighton in the championship. So you heard it here first. This is supposed to be a money matters show, but you're going to get your Bitcoin ballers analysis right here. Thank you, James, for driving us off topic. I love it.
Well, you got to keep it fun. It's Friday, you know.
Yes, it is, man. Yes, it is. Okay, so when I think about rates, and I think about there's nominal rates and there's real rates, and inflation plays into that. And so you're on stage with me. I want to know, what's your perspective on inflation? Let me color this question. Can we honestly call it CPI? And in my opinion, CPI is the equivalent of BMI for health. You know, trying to use CPI to calculate the cost of living or existing, it exacerbates one input here and may disregard another input there. So, James, what is inflation?
Well, CPI is problematic at best, right? So it's been changed many times over the years. It was initially just a basket of goods that they tracked along the way. Now it's become it's become interchangeable, where they can take certain items in and out of the basket. And for instance, one of the big things that they did is they changed housing to be owner equivalent. So using rents, and It's just they can manipulate the data to be what they want it to be. And so in reality, in my mind, a better way to track inflation is just watching the money supply. And so if you look back from 1971, since then, the money supply has grown at over 7% a clip every single year. So, and so that's really a better track for inflation, what's happening to the money supply. More money equals higher prices. I mean, it's not rocket science, right? So if there's more money in the system, then prices will go up. But looking at CPI, what the thing with it and why it's so important for the Fed is that we got to go back to first principles. Like, everybody talks about the Fed and what they're doing and how they're controlling inflation or using their tools. And the Fed has a dual mandate. It's to have price stability. It's to promote price stability. And that in the definition for the Fed, and that is a continuous constant 2% inflation rate. Okay. So we'll come back to that in a second. The second thing is full employment. But so why do they have that price stability mandate? Well, the reason that they have that and they need that is because they are manipulating the money supply and access to money, how expensive it is or how cheap it is with their short-term interest rates or overnight rates. And that's the target, right? So all that matters to them, though, going back to the first principle, why do they have that? Well, because we need to have confidence in the US dollar in order for investors, both domestic and abroad, to be investing in our treasuries. Because if they hold treasuries, then we need them to be confident and to trust that when they receive dollars back for those treasuries, when they mature, that those dollars won't be worth so much less than when they bought the bond, that they would have lost in the investment. And that's the negative rate of return. And so all they're trying to do, the Fed is using numbers like CPI, PPI, the PMI, the unemployment rate. They're using all these numbers to justify keeping that inflation rate wherever it is, and kind of hiding it a bit, And it's not, the Fed is not out there manipulating CPI and doing things that are outright fraudulent. They're using this number that is coming from the Bureau of Labor Services that is highly manipulated, and it doesn't really make much sense. So if you walk out there to the grocery store and you look at the prices of things this year versus last year and the year before and the year before that, prices aren't up just 10 or 12% overall. I mean, they're up massively, 20, 30, 40%, 50% on items, even more than that. And so what you hear people, what they feel and their frustration is coming out is that they feel like they're being lied to. And so this goes right back to your question of, why do we use CPI? And why would you even ask that question if you didn't inherently know it was flawed? Of course you do.
Yeah. And, that's funny, because when you have in a system where, or in a state of the economy where the prices are a little more uncertain, the money, even though what you're saying is that the dollar, they have to put the narrative be in front of the numbers. The numbers are there, but they use a narrative to paint a rosy picture. So people kind of recognize that they're painting a rosy picture, and it's like, it's better than somewhere else. It's better than Europe. It's better than the Middle East, Lebanon, Turkey. It's better in South America. But then when you look at the banks and you're talking about the deposits for customers, banks don't change rates on customer deposits despite the federal interest rates driving up and staying up over 2.5 years. And so It seems that banks,
this is new, by the way, Sarah. This is new. They used to, but when we got into that zero interest rate environment, ZIRP, right, zero interest rate policy, and we held interest rates so low for so long, the banks figured, well, we can get away with not raising our interest rates on our short-term loans. Well, why would they do that? Well, banks typically they make their money on the longer end of the duration, right? So they're issuing mortgages or personal
30
loans,
year.
auto loans,
Mhm.
right? So
7 year. Yeah.
yeah, and so they're paying for the short-term rate. So they don't want to pay you any more than they have to. And they figured correctly for a while there that people would just keep their money in and not really notice, keep their money in on deposit. Well, what we've seen though is most of that money is now gravitated over to money markets or CDs, which are in money markets, and so which are basically in short-term T-bills. And so we have seen that movement, but it takes an active depositor, someone who actually understands that they're not getting the right rate to make those moves, and they take advantage of it. And that there's no surprise there. They're not going to just give it away, but
Right.
that it used to be that those rates would move, not lockstep, but closer to where that short-term Fed funds rate is. But it
Is
doesn't.
it that are the customers just, not to be rude, but are they just dumber than they were 50 years ago? Is it just they're distracted, social media?
Yeah, it's a good question, and the answer is it's not that they're dumber, Sarah. It's I think that it's just it's inherent in our educational system that we avoid teaching kids about this. You didn't
Mhm.
have any when you did your math classes when you were a kid, you had one apple, two apple, all that, but you didn't really learn anything about the dollar or finance. When you got into high school, you didn't understand, you didn't learn about, um, even if you took economics, they're really kind of flawed in the Keynesian and monetary policy theories, and so you weren't taught really about money, how it works, how the financial system works. And so when you get out of college or high school and you're out there and you're living your life and suddenly you're faced with these things like buying the car for the first time, like all the levers that they can pull on that that you weren't really taught, and so, but getting them, finding the right rent, finding the right apartment for rent, and whether or not that's the right market price for that, or buying a house, or if you can afford one, investing your money, keeping up, making sure that you take a certain amount of your paycheck and put it away because you need assets to keep up with inflation, because your wages likely will not keep up. They'll lag, and that will hurt you in the long run. And then eventually you'll get to a point where we don't have pensions anymore. Very few companies offer pensions. You pretty much have to work for the government or some sort of government entity to have a pension now. These pensions they're very few and far between to find pensions in even big companies anymore.
And I'll
So
correct you. I said I worked for the federal government years ago, and they stopped pensions. So I think those pensions phased out maybe 5 years before I even
yeah,
started
and
working.
I'm thinking more of the state level where you're,
Right.
or the city level where you're working for you're working for the police department, or you're a teacher, and they do have.
Correct.
So, thank you for the clarification. Absolutely, and so, but you're not in here. So I don't think it's malevolent. I just believe that it's incentive based. So they don't. Who has the incentive to teach you about finance? Nobody does. They're
Mhm.
not going to, and they're not going to. The government isn't going to have a program where they approve a finance class that teaches kids about government finance, debt, deficits. They're not going to teach them about inflation. Why? Because the whole point of all of it is to have us plugged in to create productivity they can tax and create inflation around, so they can keep spending and have a dollar that it remains the reserve currency, the global reserve currency. The treasury is the global reserve asset. That's what they want. The incentive isn't there for bankers to teach you about these things. If you walk into Wells Fargo or Citigroup, they're not going to really teach you what you should be doing with your money. They're going to tell you where to put your money that benefits them best. Where are they going to make the highest fees or the highest returns on the, whatever that spread is for the product that they're selling you from what they're paying for it themselves. And so it's pretty simple. It's just incentives, and the incentives are broken. And we can go back to Jeff Booth and, and you just look at the incentives and you'll get your answers. And so the incentives are broken. And then, to quote Lynn Alden in the cover of her book, the money is broken, so, and that's where we're at.
I want to go to two other questions. One is I want to stay on banks a little bit more. And then I want to kind of ask something about with Bitcoin involved. But the first one, banks are still lending while the interest rates from the Fed are high to, I think, discourage that type of activity. Why aren't banks doing what they're, quote, supposed to do?
Because they don't have to. They don't have to. You can move your money into a money market, and likely you'll do it there in their facility, and they'll still make some sort of spread off it, but or some sort of fee. So, but they don't have to. And why would they if they don't have to? So they'll rather make money on a spread, hope that it's just a risk reward analysis for them. How many of these assets will move into CDs or money markets, which they'll still make some sort of spread off of, versus how much will stay in the bank in deposits. And when you do out the math, it's likely that they'll benefit from it. We're seeing it in real time here with GBTC, and we can talk about that later. But it's the same analysis. If they had $25 billion of assets in Bitcoin, and they get now they have an ETF, and they're competing with ETFs that have very low rates, 25 basis points or lower. Their rate is 1.25%. As long as they keep a certain amount of assets in their facility, because people don't want to sell and create a tax event for themselves, then they will continue to make that 1%. And that's 1.25%, and that's their bet. Their bet is that they're going to continue that, and so it's the same thing with the banks. It's just a risk reward analysis, period.
Yeah. And, that reminds me of something else. I was reading your Informationalist, and you were talking about how certain industries or certain segments of the economy are going through tough times, and certain parts are still booming, probably much longer than they should. And you talked about one industry that kind of threw me for a loop. One, the commercial real estate sector. I mean, I live 15 minutes from downtown Los Angeles. I know a few people who own some of those big buildings, and they point to one near the state crypto.com arena, and they say, oh, it's empty. It's empty. Either the US Bank one or one right next to it. And that's clear, that the commercial real estate owners, the drivers of that industry, are going to smaller office spaces. My own company, that's where the business park with 3 buildings, 3 stories high. That's that's the sweet spot. But the towers, they're empty. But then you mentioned travel and leisure, which I get it. The leisure is booming. Oh, I'm sorry. Infrastructure is booming. I understand. But travel and leisure, I'm wondering, how does that stay booming with all the government spending?
Well, I don't know what it's like where you are, but where I am, when we go out to restaurants, we go out to shows, we'd see a lot of older demographic. And so
I get it.
And that's, just my visual. But the reality is that when we went through the pandemic, what I surmise is that we had a steep drop off in the workforce, right? So remember, there's a lot of people just left the workforce. Well, there are a lot of things going on. Some people started YouTube shows. I mean, I left the workforce. We know a lot of people who just opted out and said, I'm going to do something else. I'm going to be an entrepreneur. I'm going to be an entrepreneur because I don't have to go to an office. I might as well do it myself here. Okay. Well, I'm doing the same thing. I'm in my house, in an office in my house with a hedge fund. I don't need an office. But by and large, I think the largest demographic that left the workforce was the boomers. The boomers left the workforce because they were like, well, look, all assets increased. They all appreciated. My house is now worth 40, 50, 60, 70% more than it was just a few years ago. I can either sell that and downsize, or I can borrow against it, or really, my IRA and my 401k is up massively. And so, I can start taking distributions now, and I can do this ad nauseum. I don't have to worry about working anymore because I've got both my largest assets, which are my house and my retirement account, are up. I still have a pension because I'm a boomer and I worked for a company that had pensions back then. And my mom has a pension from my dad working at GE for, 30 some odd years. And so she's getting a pension from that, plus Social Security, plus, 401k benefits that they have to take distribution on, and the houses, and selling, or just selling your house and making a whole bunch of money and going into an apartment or someplace smaller. They're sitting on piles of money. This is not a secret. Everybody knows about it. So they left the workforce and they're just out there traveling, going to restaurants, going to shows, and it's absolutely, it's incredible. It's breathtaking how much money has poured into the system in just that area from that demographic, and it continues to. And so that's something that I'm watching closely, and we'll see what happens with. But those are areas that really have expanded. Why the infrastructure expand? Because of the Inflation Reduction Act, which is an absolute joke. But it just poured money into infrastructure and green projects. And so you've got that
ESP,
going on,
yeah.
so you've got manufacturing and construction, and those are all booming. You've got massive hiring in Washington, D.C. It's just endless hiring out there. And at the same time, you're just seeing this capital pour into areas that are expanding, like defense contractors are getting a lot of money,
Yeah.
And so, and in pockets that we aren't even aware of because they're not made super public, right?
That's right.
So they're in the government equivalent of an off-balance sheet entity,
Plenty of those.
So and so that's happening because the Treasury and the Department of Defense, I mean, they're not balancing their books properly. They lose hundreds of billions or $1 trillion plus dollars. And so where did it go? And it's in the economy somewhere. So
$6 billion on average annual that they miss that the Department of Defense miss budgets, I think. Every year. It doesn't matter. Yeah.
Doesn't matter. So, but look, this is not conspiracy. It's just the system is just fraught with with incentives that are problematic and structural issues. And so that's kind of where we're at. So the whole point of all of that, sir, is that we have areas of the economy that we clearly are feeling recessionary. They are in recession. Commercial real estate is a prime example, like you said. It's highly interest rate sensitive, and at the same time, especially in the office building area of commercial real estate, office, real estate, we don't have people coming back to work, which means that meaning they're not going to the office as much.
That's right.
They're going to the office a few times a week, which means you have shared office spaces. You have these businesses that are like, well, I don't need 10,000 square feet of office space. I need 2,500. So I'm gonna downsize to 2,500. And so you have a 75% haircut on that one customer, and that's happening across the board, whether it's 30% or 80%. It's happening across the board. And so these commercial real estate office, the office buildings they're not able to charge the rent that they once were. And at the same time, the notes on those buildings are coming due. So they're either taking a loss on it, the owners are taking a loss on it and handing back the keys to the banks, because there's no recourse loans. You just hand back the keys and you're like, well, it's yours. You take the loss. I'm out. You have my deposit, And so, and they're doing that. We're seeing it over and over again. The other areas are highly interest rate sensitive areas that are companies that need to borrow. That you're seeing it in some technology companies, layoffs all over the place. Hundreds of thousands of people have been laid off because highly interest rate sensitive, meaning they have to borrow, and they're borrowing on rates that are they're not fixed. So, and the problem is, as these rates move, they're having to pay higher rates in order to keep the business going. That decreases margins. It means that they have to figure out a way to remain profitable, or at least protect their cash, even if they're not profitable, and some of them are burning money away. But when you have interest rate sensitive industries are feeling it too. And so you've got these pockets that are absolutely in recession, and you're seeing layoffs. And then you've got other pockets that they seem to be going gangbusters, and there's hiring and government spending. And so that literally right there is the fiscal, the fiscal policies, which are fiscal deficits, endless spending, just reckless spending out of DC and the government. And this is, by the way, this has nothing to do with party dynamics. This happens with both parties. That's and right. Then at the same time, you've got these monetary policies, which are they're supposed to be restrictive. So you've got expansionary policies coming out of Washington versus restrictive policies coming out of the Fed, and they're kind of banging against each other. And honestly, fiscal is winning. The government is winning. The money is pouring in, and assets are inflating, and the Fed knows that they have this issue that we may get into stagnation.
Stagflation or stagnation?
Stagflation.
Okay, just making sure. Like, let me pull out my notebook. Okay, what the hell is stagnation?
Stagflation. It's Friday, man. We got basketball. So we got.
I played last night,
and so and that's the question: is how long can this go on for? Because as an investor, having been doing this for over 30 years, it just blows my mind, Sarah, that we're in an environment that the government is spending and spending and spending and spending and spending, and we're running deficits at a time where we're not even in a recession. We're not technically in a world war. We're just spending endlessly, running these deficits, borrowing to no end, at a time where we don't really need to. The only reason they're doing it seems political. And so, and again, it's not, look,
election year, you have to make things look good.
Yeah, right. Both parties suck, but it's just what it is. And so this is where we're at.
Yeah, I thought I wanted to get right into Bitcoin, but then again, these topics are so intrinsic to, or so critical to how we look at a new monetary system. When it comes down to all this spending by people that shouldn't honestly be spending, there should be enabling capitalism, enabling productivity. But the government doesn't create profit. The government doesn't create value. They're supposed to be the policers to make sure the monopolies don't form, make sure people are abiding by the law. One question is, how long can this keep going? Back in 2023, I know you've been, that's how I was introduced to you. It's like, hey, how long can this keep going? That's like almost a lot of people's catchphrase, including yours, for a season. But it's like back in 2023, you were certain that a recession is coming. Obviously, it's not truly here. It's segmented inflation. It's segmented recession. But how long can this printing, spending continue? At some point, someone has to call them on, the emperor has no clothes. you have no money in your coffers.
Yeah.
How long?
It can go on for a very long time, especially here in the United States, because we do have the benefit of having the global reserve asset in the treasury and the global reserve currency in the dollar. So they can go on for a very long time. And look, and it's gone on for many years in Japan. It's a different demographic, it's a different structure, and so, but it just demonstrates that it can go on for a long time, depending on the factors. But so what is happening? Well, we're in these boom and bust cycles, and we're continuously in these boom and bust cycles. And so what we're seeing, though, Sarah, is that these cycles they're getting closer together, right? So the time between them is shortening, and then the amount of help, stress on the system and help needed from the Treasury and the Fed is spiking. It's going to higher and higher levels each time. So if you look at back in 1987, for instance, when we had the crash, the stock market crash in 1987, Bernanke came in, or Greenspan came in and said, "Hey, look, don't worry, we've got your back. We'll be there to backstop the markets." Why would they do that? They do that because they know that they've got to keep the Treasury market liquid. They've got to keep confidence in U.S. assets. And so that's where it all started. Flash forward to 1998, the New York Fed, they negotiate out and structure a bailout for long-term capital management before they collapse the whole financial system with their just enormous, massive leverage that they were levered over 100 to 1. And so the Fed helped them out there. And then flash forward, you've got the internet bubble. Then flash forward, you've got 2008, you've got the great financial crisis, and the Fed and the Treasury, that's where they really started pouring money into the system. So that was the first lick, $1 trillion plus, right? Then the next lick is over $5 trillion in 2020. So what's going to happen the next time? Well, at this moment, we are running deficits that are somewhere between 6 and 7% of GDP. And so it means we have to borrow that much more every single year in order to make up the difference. So we're watching our debt balloon. It's gone from just over $30 trillion to just under $35 trillion in about a year and a half. It's mind-boggling, right? So we're seeing it balloon, which means that we need more liquidity, which means that we need more, we need enough money in the system. So if and when, it's really just a question of when something breaks. And this is your question of when are we going to see there's going to be another wave, there's going to be another boom, another bust. And when are we going to see all this? Well, we're going to see it when we come into a liquidity crisis in the treasuries. And that means that the money just isn't there to soak up all these treasuries. It's not willing to, it's not available there to soak up all these treasuries, and you start getting these short-term rates that blow out, right? The overnight rates, they blow out between banks because they don't have liquidity. And so, and we saw this back in 2019. It was called the repo crisis, where what happened was the Treasury was they issued, or they auctioned, an unexpected amount of treasuries at the same time that companies were making tax payments for their October tax payments, right? They were putting money aside for that. So they had less liquidity, which meant that the reserves were down. And then suddenly you got into a spot where the treasury auctions were getting a little bit unruly. So the Fed and the Treasury had to come in and help out. And so they don't want to do that again, but we're kind of headed toward that same path. So I kind of liken it like this. There's a tsunami coming. We know it's coming. and it's a tsunami of debt. It's mathematics. It's no secret. It's clear. I've written all about it. It's the debt spiral. It's just math. This is not, again, it's not rocket science. It's not, you don't have to be Nostradamus to see this. You just do the math. And the issue is that we're running such high deficits, we're borrowing so much that that eventually the interest payments are going to soak up all of our tax payments.
That's what I was about to ask as well. Like once that milestone happens, I think last year we hit either 900 billion or a trillion in debt interest payments for, I guess, annually.
That's our run rate annually. Yeah.
Right. And then we get about 3 trillion. The US government gets about 3 trillion in tax receipts. So it's growing exponentially. So it's going to come faster than most people predict. Just like Jeff Booth says, people don't understand the power of exponentiality.
Right.
When let's just say taxes stay at 3 trillion, when that debt interest hits 3 trillion, does that just trigger nonstop treasury printing?
Well, first of all, the tax revenue is closer to 5 trillion now. It's
okay. I was reading the wrong chart. Okay.
So, but let's go. That will become an issue eventually. It's a little while off, but that will become an issue eventually. What's first going to happen is it will be the largest expense in on the budget, right? So on the
welfare, defense, it'll pass up all that.
Yeah. Yep. So Social Security, Medicare, Medicaid, it'll be the top line item, and that's coming soon. But so going back to the analogy of, we have the tsunami. So you had this first wave of 2008, which is, the tide went out and then the money came pouring in. And then the tide went out again in 2020 and an even bigger wave came in. And now you're going to have another tide. The tide goes out again at some point here. I don't know when, but at some point here, the tide's going to go out again. We're going to need multiples of the liquidity that we issued last time. Like, the wave is going to be even bigger. Now, is that the tsunami yet or not? I happen to think it's not. I think it's it's a couple of cycles off, but it's going to be a massive amount of liquidity, which means a massive amount of inflation, which means, going back to your question about Bitcoin and the hard monies. And that's why it's going to be so important to have assets that you can store value in, because there's going to be a massive amount of inflation. Luke Groman talks about this quite a bit, where they're going to have there's really no choice. You've got a couple of different choices on how to manage the deficit. So let's talk through those really quickly for your listeners who haven't heard me talk about this before. The first thing you can do is have austerity. You can cut spending, right? Neither party's going to do that. It's political suicide. They don't want to do it. They're not going to. Okay. So that's the first thing you do. The second thing you do is raise taxes. I've seen people talk about this. The modern monetary theorists love to talk about this. We've got Biden out there talking about taxing the billionaires. You're going to tax them $500 billion over 10 years. Yeah, that's great. That's $50 billion a year. That's literally, you're spending that in a matter of days. It doesn't that's going to do nothing. Okay. So it's very popular to say it, but it's going to do nothing. If they really did raise taxes structurally, sir, on the entire population, or the biggest money earners there, okay, corporate taxes, middle to high income earners taxes, if they really did do that, what does it do? Well, it disincentivizes productivity. You're not going to work as hard for that incremental dollar that's going to be tax at a much higher rate. You saw it happen in France, where they, tax people at 90% at a certain tax bracket, right? So we've had it here. Right. We had taxes like that last century. But so the bottom line is, it disincentivizes productivity, research and development, companies reinvesting in profitable lines or expanding lines of productivity or products. And so what ends up happening is you get to the same spot. So you have higher tax on lower productivity. So you end up with the same output. The problem is, though, that you have declining productivity at the time where you have higher tax rates. You get into a worse spiral. So that doesn't work. The third thing you can do is, which we have been doing, is just issue more debt. You borrow more money to pay for your past grievances, right? So so it's just like having a credit card. You take out a credit card to pay off an old credit card, but now you've got this new credit card that you've got to pay off. You got to take out another credit card. It's the same thing. They're doing the same thing.
Pushing it down the road. Yep.
Yeah, they're just kicking the can down the road. But while you do that, what's necessary to keep that charade going, which we've witnessed, is high inflation. You just have to have inflation, perpetual high inflation, in order to create fake productivity going forward, right? So, and that's kind of where we're at, where we have this high structural inflation. It's stuck at 3%. It's stuck there because of what we talked about with the government. Running high deficits is inflationary. And so they're doing that. And so now we have the sticky inflation above 3%. And so we're going to continue to see that. Whether or not they allow it to run, and that's CPI. The real inflation is likely much higher. But right. Whether or not how much they allow that for that, that's what we're seeing. Okay, so going back to what I was talking about, what Luke Groman talks about, is that the other thing they can do is, in that inflationary calculation that we're talking about, is they can allow inflation to really run hot for a number of years, a la 1980. The difference is that back in 1980, our debt to GDP was down, 30%. Now it's 120 to 125%. Yeah. Okay, 125%. So it's a much different situation now, because when you run those, when you allow for that high inflation, if you raise your interest rates along with it to at some point tackle that inflation, you risk really ballooning your debt to a point where it's just completely unmanageable. So, but they could just allow for some serious inflation, and rather than use monetary policies, high interest rates to manage that inflation, they could just draw money out of the system through either banking laws or just completely decimate the deficit and stop spending. They could structurally lower benefits for Social Security, Medicare, Medicaid. Those are the huge expenses. We're looking at unfunded liabilities now of about 215 trillion dollars. Mm-hmm. Those are expenses that they could start to tackle. It would hurt. So let's make it clear. If they do this, it will hurt, but it would save the dollar. So you better, if you are in the United States and you're a wage earner, I implore you to start buying assets. As far as Bitcoin is concerned, in my mind, I can't tell anybody what the right thing is for them to do, because you may have short-term needs. But if you have capital that you don't have short-term needs for, then you should own things like Bitcoin and gold. If you can own real estate, something. Bitcoin is my favorite. That's why I started the hedge fund, the Bitcoin opportunity hedge fund. But, having those assets that will protect you from massive bouts of inflation is going to be necessary, in my opinion. And so things like gold and Bitcoin will do exceedingly well.
Yeah, the good thing about Bitcoin is that it enables people that are priced out of assets to have a chance to own them. And you can
own just a tiny bit. You can buy $5 a day. That's right.
That's right. That's right.
Sorry, I interrupted you. Yeah.
Oh, no, that's fine. Yeah, this trust me, this is good. But like even gold, finding a place to buy gold for the
Yeah,
common investor.
it's
So
problematic.
weird.
Yeah, it's
It's
problematic.
weird. And then the fees on that, on top of that. And of course, real estate, again, the rising price of real estate, $400,000 for the average home. It's just, like you said, problematic. Talking about Bitcoin, you had a presentation in Madeira. I didn't go, of course, but I heard your summary about it. And it was during a very interesting time with the Bitcoin price. But you were talking about its past performance. Now, we know the saying that past performance does not necessarily indicate future outcomes. And sometimes it's used to attack Bitcoin. I'll talk to people, hey, I'll say the same thing. Look at what it's done in the past. Well, how do you know it's going to do that in the future? It's a scam, it's a bubble, blah, blah, blah. So it's used, and it can be used to temper moonboyism as well, where people say it's going to $1 million, Balaji, and it's like, chill out, bro. Like, that doesn't, just because it went up, 2012 doesn't mean it will happen again. But I guess my question is, when are you forced into other means like rationalism or analogous testing to sort of project where Bitcoin is going? It's hard to just say, yeah, from 16 to 20 it did this, so from 24 to 28 it will do that. What are some of the other tests that you can use to prove Bitcoin's trajectory?
But that's a good question. We see all kinds of models that show what Bitcoin's price should do according to past cycles, the past epochs, the halvings. We've seen models that are really supply driven, and that to me, it's really difficult to pin down the future of Bitcoin on those types of models. For me, I rather would use models that are more like the adoption curves. So we saw the adoption curves in things like the cell phones, in Amazon. You can see that adoption curve, and you can see where Bitcoin kind of follows pretty closely to that. And it makes sense. Why does it make sense? Because when you think about it, Bitcoin's a network, and the network effects are what are driving this adoption. And so you can see that exponential adoption curve occur. So now what you do need, though, is you need additional capital, and you need additional people. You need more people who are understanding and involved and investing in this ecosystem. And so that's what's really important. So what I like to do is I like to look at those adoption curves and then just think rationally, back up and think rationally about, well, what if this is a true store of value to start, right? If that's what the beginning of this is, and yes, Bitcoin is money. I do believe it becomes, much more widespread. It has much more widespread use on the base layer, on the second layer, on
Lightning,
Lightning, and or whatever else will come from that. But the starting point, let's call it the ultimate store of value. Well, so let's just back up and think about that. Well, there's just under $1 quadrillion of assets in the world now, right? So with real estate, residential real estate ballooning up to over $500 trillion this year, according to what is the stat? I'll think of it, but so you've got residential real estate of 500 trillion. You've got bonds of like 130 trillion. You've got stocks are 110 trillion. You've got M2, which is about 90 trillion. You've got gold, fine art, all that stuff. When you put it all in, it's just under $1 quadrillion, right? So commercial real estate is in there. That could be anywhere from, 80 to 120 trillion. You know, it's difficult to put your finger on it. Now, remember, commercial real estate is not just office buildings. It's a lot of other stuff. It's retail strip centers. It's you know, health and medical properties and campuses. You know, so there's a lot more in there than just the office buildings. But let's just call it somewhere around 100 trillion. So Bitcoin right now at just over $1 trillion is literally 0.01% of that. You know, or 0.1% of that, 0.1% of the entire total. So if this does truly become the ultimate store of value, which we believe it will, I'm speaking for you, but I'm pretty sure you believe that.
Kind of.
Then it's going to take over gold. Gold's about $10 trillion, give or take. You know, a lot of that is in jewelry, but let's just call it $10 trillion. So you know it's going to 10x just right there.
Yep.
That's a pretty simple putt, right? For gold to take the mantle from Bitcoin to take the mantle from gold. So that's a 10x right there. If you just step back and think, okay, if this really is a true ultimate store of value and it has fewer problems than gold, right? It's easily transferable. It's easily auditable. You know, it's not like gold where you have a bunch of paper derivatives all over it and you're hiding how much is actually in a vault. No, like you can see it right there on the addresses. Yep. It's on the time chain. You could see who owns what basically and what's in what wallet. And so it's going to be and the supply is absolutely limited to 21 million coins or just under that. So 21 million coins, you know, the number of them have been lost. It's actually, instead of being inflationary, it's deflationary, because as people lose their wallets, you know, they if somebody dies and they have not had a plan to hand those wallets off to their successor, then those are lost. You know, if you don't have an inheritance plan, those are gone. And so every day more coins are lost. But if you just look at it as the ultimate store of value, and you just do out the math, right? If you just do out the math of if you say that it's going to be a 2, 3, 4, 5% allocation across the board, it's going to take a little bit from real estate. It's going to take a little bit, because there are people who invest in real estate because it's a great store of value. But
where else would they put their money? Like in their local fiat? I mean, a lot of oil tycoons, they go buy flats in London. Why? Because why would we hold in dollars or the local currency? Exactly. So they buy empty flats in London, right?
And if you go and look at the bonds, again, if we're talking about high structural inflation, you have periods of high inflation and the interest rates don't keep up, then because the Treasury and the Fed are working to make sure that they can manage the debt. It's not really the Fed's job. I understand that. That's not, but the Fed does work for Congress, basically.
That's right.
They answer to them. So, but when you have those high periods of inflation, well, investors will demand higher rates. If they don't get the higher rates, then they're going to turn to other stores of value than bonds. They're certainly not going to buy a 30-year treasury if they know that the dollars that they get back are going to be worth a fraction of what they were when they lent them out. So they'll start
real rates.
Right. So you could see Bitcoin eventually not becoming just, 1% of this whole, complex of investable assets, but multiple percentage points of it. Right. So if it gets to a 3%, 5% allocation across the board of all these assets, I mean, now you're talking about an asset that's not worth just a few trillion. It's worth 30, 40, 50 trillion dollars.
Yep.
Massive difference. And so I can see that in the future, not today, not in the next 5 years, but certainly I can see that happening in the next 20 years. In the next 10 years, it starts to really eat away. I would say that it is absolutely knocking up against gold for that store of value in the next, 7 to 10 years. I fully expect that. That's not, again, that's not, I don't think that that's really far out there on the thought curve, because of the things that we said, because it's such a superior store of value. Even guys like Larry Lepard, who has been a gold bug for
he's
decades,
on next week. Yeah.
He will tell you Bitcoin is superior in every single way. And so, and we're talking about a very US centric view here. When you step out of the US and you think about the use cases and the store of value in places like you mentioned before, Lebanon, Venezuela, Argentina, when you have these places that have had such massive inflation that their currency has been devalued to less than 1% of what Bitcoin is over the past few years, it is a store of value for them. It doesn't matter how volatile Bitcoin is. It is absolutely a store of value already to them. And it enables them to keep their assets and be able to move anywhere in the world with them, And so you and I know the Sultan of,
Bhutan.
Exactly.
No.
So and he left Venezuela, right?
Oh.
And his entire family were able to keep.
I don't know that story.
Well, he has told us. He told it on Spaces a couple of years ago, but he was able to flee, that area because he was able to store his family's assets in Bitcoin, and they left with it. You can do that in Egypt or in Lebanon. You can take your assets. If you can get out of the country, you can take your assets with you. You can't do that with gold. You can't walk across the border with a suitcase of gold, right?
You can't walk across the border with a suitcase of dollars. You're limited to $10,000, or they're going to start asking questions.
Right. So getting out of just the U.S. centric view of it being just an investment, like this is it's a necessary store of value for people who are in super oppressive financial regimes, and so it is absolutely necessary for them, and you're going to see more and more of that. And as the dollar continues to grind these other currencies,
put pressure on those people
and crush them, and they have massive inflation because of it, and not to get too deep into it, because they have dollar denominated debt that they have to inflate their own currencies to keep up with. It crushes their own citizens under that mountain of money printing. And so those are all factors. So forget about the supply curve for me. For me, it's all about the demand curve. It's about the adoption curve. And so it's clear to me that, barring some global, coordinated outline of all digital currencies in Bitcoin somehow, which I don't even know how that could be, but I guess it's a non-zero chance, but it's about as low as I can think it would be. Barring something, maniacal like that, this to me has the highest risk reward properties of any single investment I can think of today. Period.
Right on. Hey man, I really value the time that you gave to me today, and we're coming up on the hour, but I do have to ask one more question. And you had a conversation with Nico last week, my mentor for all this work that I do in the social media space, and it was about, you're at dinner with some of your buddies, Jeff, Preston, and a retired man came up to you and claimed he didn't need Bitcoin. And I got a rip from your dialogue with Nico there. I want you to share that same story in an abbreviated time if you have to, but kind of share that story with what you had out there in Madeira. Go ahead.
Yeah, I mean, we had this big table. We're all talking. We're talking about Bitcoin, of course, because we're in Madeira. We're all talking about Bitcoin. And this older couple was a couple of tables away, and as they're walking by, they say, "Oh, you're here for the conference?" Yeah. And he said, "I heard you talk about Bitcoin." Yeah. And he's clearly in his 80s, and you know, and he basically just said, like, "I don't own any, I don't believe in it, blah, blah, blah." And I said, "Well, why don't you believe in it?" He said, "Well, because, you know, all the fraud and all that." I said, okay, I understand that, but that didn't have to do with Bitcoin, the protocol. It had to do with bad actors. It's no different than all the fraud that we see in the nefarious activity around the US dollar that isn't caught. And the US dollar is really the currency of choice for criminals. And I said, in reality, it's not. You know, this is not the best way. You know, if you're a criminal, you don't want to use Bitcoin, because if it can be tracked, unless you only ever you know, transact in Bitcoin. You can't get it back into dollars or the system without it being seen. So anyways, he said, "Yeah, well, it doesn't matter. I don't need it anyways." I said, "Well, you know, don't you have kids?" And he kind of shrugged. He said, "Yeah, but they're fine." I said, "Well, what does it matter?" I said, like, if we're right, and that we are on the beginnings of a collapse of fiat systems because of all the debt in the world. And he said, "Well, yeah, I could see that." He said, "But it'll happen after I die." I said, "Okay, well, what about your kids?" And again, he's like, "Okay, but what about them? How does Bitcoin help them?" I said, "Well, if we're right, then 1% of your portfolio in Bitcoin could, you know, that 1% could multiply by 100, 200, 500x. And the rest of your portfolio will basically, if it's in, you know, fiat denominated things like bonds and stocks, it could go to, you know, more or less zero." And he said, "Yeah, but, you know, how, you know, then 1%, he said, would that really help me?" And I said, "Well, just think about it. If that 1% would then it would be multiples of your portfolio, because it would hold that value. So it'd be worth 100, 200, 300x. I said, "And if I'm wrong, then you lost 1 or 2% of your portfolio. Who cares?" You know? And he stopped and he thought about it, and he thought, "Yeah, you know what? I can't really argue against that." I said, "That's the point. The point is that the only wrong answer for how much you should allocate to Bitcoin is zero. And so just like 1 or 2% is a good start. And then I think it'll force you to dig in and really learn about it. And when you really learn about it, you seem intelligent, then you'll likely want to own more, especially for your kids and your grandkids, and for your legacy." And he said, okay, I understand now. And that was it. So, but you know, it was a pretty short, it was a pretty tight window to try to orange pill somebody who's a boomer. He doesn't need it. Plenty of money, retired in Madeira, and plenty, he doesn't care. But he thought about it. He's like, "Yeah, that makes sense." So hopefully it worked.
The catch about that story is that even if he doesn't take an action on it, the story that you have there and your ability to share it, you know, on the radio waves, on the social media waves, it's likely that someone else is going to hear that, and it's going to trigger them to make what would probably be a life-changing decision. James, I appreciate you coming on my humble show. It's been fun to catch up with you. I hope to see you again at a couple of conferences, whether it's Nashville, Pacific Bitcoin, and just keep on doing what you're doing. You are definitely demonetizing education everywhere with all the things that you bring to board. Thank you so much.
Thank you for having me, Sarah. It's awesome to be here, and I love your show. So great job. Thank you for having me.
Appreciate it. So James was great. I appreciate him coming on. All the stuff that he talked about was deep, but at the same time, it was palatable, easy for us to understand. I want you guys to look out for more shows in the coming weeks. We're going to have Lawrence Lepard. We're going to have Coin Icarus, Nico. We're going to have Jeff Booth sometime in the near future. I am Sir Ulric, like my father before me. See you next time.